Welcome back. Earlier today, the Federal Reserve met during the regularly scheduled meeting, leaving rates unchanged at the 5.5% level. What we're going to see in just a moment is that the market expectations have shifted to some extent as a result of this meeting and some news that has occurred recently. Here we see the 10-year bond in blue. That's the yield is quickly approaching the 1-year bond, leaving us with a much more optimistic outlook. At least that's what the bond market's telling us. Federal Reserve Chairman Jerome Powell in part said, "We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it." He's speaking in regards to the strengthening economy and the positive economic numbers. He also said, "I still believe and my colleagues for the most part still believe that it is likely to be true that we will need to see some slower growth and some softening in the labor market to fully restore price stability," meaning that maybe they're not going to reduce rates so quickly until we see real soft conditions emerge. He also said the idea that it would be difficult to raise again after stopping for a meeting or two is just not right. The committee will always do what it thinks is appropriate at the time. Now, here we can see this is what October looked like. At the time, the black line represents the percentage chance the Federal Reserve will raise interest rates. Now, at the time, that stood at at December, January meeting. It was around the same period of time, or the same percentage rate, I should say, around a 39-40% chance that the Federal Reserve would raise interest rates. That's the best chance that the Federal Reserve will raise interest rates, gives us a 40% chance. And that we have here in June represents the first time that these are the Fed funds futures that the Federal Reserve has a better chance to lower interest rates, to ease interest rates. Now, notice these numbers, 39.6% and 53%. That was in October. Well, that 39.6 becomes 30.4. So the expectation has dropped again from 39.6 to 30.4. There's a less of a chance that the Federal Reserve will raise interest rates. The market thinks we're closer to the end. Also, in October, we had a 53% chance that they would ease rates in June. That is now up to 69.5%. So the shift that we've seen is a shift towards a greater chance to reduce interest rates still at the June meeting. That's when we have the first month where, or the first meeting, they'll have a better chance that they'll reduce interest rates. But also the expectation to raise rates in January, which is the best chance to raise rates, that has waned to some extent. Today's change in treasuries as a result and part of the Federal Reserve meeting, we see across the board yields are down, mostly though in 357. These are the midterm yields. This is where current U.S. Treasuries stand. The short term, the 1 month, 2 month, all the way to 6 month, we have 5.5% and above. The 10-year is much lower at 477. So we still have very much an inverted bond market where the short-term maturities are paying a lot more than the longer term. However, take a look at the 1 month percentage change in treasuries. We've seen a real sell-off on the short-term side of the spectrum, meaning that the interest rates on the short-term yields have come down, maybe moving closer, like the Federal Reserve's statement and also the subsequent Fed funds futures, that we're closer to actually lowering rates than we were last month this time. Long-term rates are rising, and we'll see in just a moment we may reach a point where we have a flat bond market where the short and long-term yields pay the same amount. Here we see over the past 3 months what has happened in the bond market, and the short-term rates are at the top. They have hardly moved. The longer-term rates at the bottom, the dotted red line here, that's the 10-year. The white line's the 30-year. The brown line's a 7. And then we also have the 5-year and the 2-year, etc., or the 5-year as well. So what's happening is we see the longer term rates are moving to the upside. The short term rates are staying flat. Now we have an inverted bond market because the long term yields are lower, but still we are moving up. Here we see another picture of it. The 10-year bond is in blue, and we did have a massive divergence at one point. The inversion was 150 basis points. That the short term, the 1-year yield was 150 basis points, 1.5% higher than the 10-year. But that is contracting, and that is a result of, well, the short term, the red line, is coming down because of the expectation in near term, we may be a little bit closer to the end of raising interest rates. But in the long term, the Federal Reserve says the economy is stronger than we thought. So that's why the longer term rates are coming. The longer term rates are down a lot, anticipating very weak conditions in the future. Well, now the longer term is sort of pulling back on that weak expectation. So in the long term, the bond market, the Federal Reserve, the Fed fund futures, they're all kind of telling us the same story that over the long term, the expectation is conditions look better. On the short term, well, that we see the Federal Reserve is probably closer to not raising interest rates anymore. And over the long term, maybe 6 months out from now, 8 months now, in June, we actually have a better than fair chance that the Federal Reserve will actually cut interest rates. We have a very big economic calendar still this week. We have jobs numbers and much more. So we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.